Okay, year 13, let's have a quick look through public limited companies, PLCs. Okay, look at the features, pros, cons, and private equity groups. So it'll be pretty high speed, hopefully. You've got some features of a PLC in your textbook. You should already know quite a lot about them, but let's just run through. I'll just run through pros and cons, and that'll really give you the features. A public limited company is essentially a limited company, the same as a private limited company was. That is, it's a company, it is a distinct business that is separate from the owners. So it has the same features in that regard as a private limited company. It also, as the phrase limited would imply, has limited liability. That is, the owners have limited liability, the shareholders have limited liability for debts. So their liability for debts is limited to the value of the investment that they placed in the business, and their personal belongings will remain protected in the case of the business failing and going into what we would call liquidation, where it's shut down and the assets sold off to try to recoup some of the outstanding unpaid debts. The key difference between a private limited company and a public limited company is that a public limited company, as you might have guessed, can sell shares to the public. And how does that happen? Well, the shares would be sold on the stock exchange. You would say that the business is floated on the stock exchange, and that just means that the shares are available to buy and sell to the general public. What are the reasons for that? Well, the main reason is to provide more capital generally for growing the business. So say, for example, if you wanted to grow your business and maybe move into different countries and set up new factories in other countries, that sort of thing, then that's going to be very expensive. That's going to cost multiple millions of pounds in most cases. If you only have, say, a small family firm with private limited company status, you're going to have a very restricted number of people who can actually become shareholders and invest in your business. So that business model may not be compatible with the level of ambition that you have for the growth of your business. In that case, then you've got to consider expanding by selling shares to the general public, and that's when you should think about becoming a PLC. There is a minimum investment level, a minimum share capital of £50,000, but that figure is really it's really irrelevant now, because that figure's been around for probably 30 or 40 years, and there was a time when that maybe seemed like a significant amount of money, but realistically now, I spoke with a stockbroker about this, and I said, what's a realistic figure to think about floating on the stock exchange in terms of your company valuation? And he reckoned 20 to 30 million, and he said, look, if you're anything less than that, then realistically it's not worth your while in terms of the fees that you would have to pay to merchant banks and just the cost of promoting the flotation, because you've got to make potential investors aware that your business is actually out there and the shares can be bought in it. So the £50,000 minimum is it's still valid, it's still a legal minimum, but it's not a practical figure. There are lots of private limited companies that have more than £50,000 worth of share capital. So anyway, the main reason is it gives you funds for growth. It gives you more credibility with lenders, suppliers and customers. There is a significant kudos or status improvement associated with being a public limited company with listing on the London Stock Exchange. And we mentioned already about shareholders having limited liability. Downsides, as I mentioned already, the cost of the stock market flotation is going to be substantial, and realistically that is going to easily get into hundreds of thousands of pounds, and if you're looking to raise substantial amount of money on the stock exchange, that could easily get into the millions. It's usually a small percentage of the cost, but the total market capitalisation. That is the value of all the shares sold on the stock exchange. But it's a pretty substantial undertaking, and the professional bodies who would get involved do so because it's very much in their will to do so. And it's not going to be a few £1,000s, it's going to be hundreds of thousands. There's a loss of control because, in terms of the another downside of a public limited company, selling your shares to anyone and everyone via the stock exchange means that anyone could come along and say, right, I'm going to buy a substantial chunk of this company because I like it and I think it's a good investment, but I want to have control. So essentially this is what happened with Manchester United a number of years ago, where the Glazer family came along and basically said, right, we want to buy a majority stake in Manchester United and become the owners, majority owners, and control the club. And essentially they didn't just do it in one chunk, but they did it in a number of steps where they bought up significant tranches of shares until they owned more than 50% of the shares. And once they got to 51%, they called an emergency general meeting of all the shareholders and they had a vote. And the single item on the emergency general meeting agenda was the majority shareholder would put forward that or proposes that the remaining the other shareholders sell all their shares to the majority shareholder. All those in favour say aye. No, only Malcolm Glazer put his hand up. All those against say no. Everyone else said no. Malcolm Glazer said, well, I've got 51% of the shares, so actually I win. That's democracy in action. And so it proved. Very controversial, caused an awful lot of bad feeling with a lot of Manchester United owners and fans, but that's how it happened. And essentially then the Glazer family took control of Manchester United. So that can happen. Risk of takeover. Large businesses are often less flexible because you've got to state exactly what the nature of the business is. You can't just chop and change that. Also, you have to get agreement from shareholders if you're going to do that sort of thing. If you're making those substantial changes, that would have to be approved in an emergency general meeting or the annual general meeting of the shareholders. Day-to-day running of the business is done by the directors. The shareholders are not involved in that, by and large. There may be a few institutional investors who maybe own, it could be even like £10 million worth of shares, or maybe more than that, and they would say, right, well, if I own that much of the company, then I want to have some say in how the business is run, because if the business is badly run, I'll be so seriously affected by that. So there's some logic there, but that can be very much in the short-term interests of that institutional investor, and that's not always the best way to govern the company. There's a loss of personal touch because of the size of the company, and your accounts again are public, even more so than the way the private limited company ones were, because your accounts are not only available on Companies House, but generally would be available on your website, and it would be required of you that they're made available to financial journalists and the media in general. Okay, so you've got a few things you can look over there with your notes. So that's pretty much private limited companies.